If you've ever sold something and waited to get paid, you've dealt with accounts receivable. And if you've ever bought something and paid later, that's accounts payable. These two are at the heart of how businesses manage money. In this video, I'll show you exactly what they mean, how they work, and how to record them. With real examples, clear steps, and no confusing jargon. Let's break it down so you can finally understand how receivables and payables fit into your books. Let's start with the basics. Accounts receivable is money that your customers owe you. You've delivered the product or service, but you haven't been paid yet. It's basically a promise that you'll get paid soon, and that makes it an asset on your balance sheet. On the flip side, accounts payable is money you owe to someone else. Maybe you bought inventory or hired a contractor, and you haven't paid the bill yet. That makes it a liability because it's money you still have to pay. Both of these are normal parts of doing business, and tracking them right is key to keeping your cash flow healthy and your financials accurate. So, why do accounts receivable and payable matter so much? First, they help you understand your cash flow. You can see when money is coming in and when it needs to go out. That timing is everything. Second, they show exactly who owes you money and who you owe. This helps you stay on top of payments and avoid surprises. Third, they're key to running your business smoothly. Paying suppliers on time keeps good relationships, and following up on unpaid invoices keeps your income steady. If these numbers are wrong, it can affect your profits, your taxes, and the trust others have in your business. That's why keeping receivables and payables accurate is a must. Let's walk through two simple examples, one for accounts receivable and one for accounts payable. First, accounts receivable. Imagine you provide $1,000 worth of design services to a client, but they'll pay you later. Here's the journal entry you record. Debit, accounts receivable, $1,000. Credit, sales revenue, $1,000. This shows you've earned the income, but haven't received the cash yet. A week later, the client pays you. Now you update your books like this. Debit, cash, $1,000. Credit, accounts receivable, $1,000. The receivable is cleared and your cash balance goes up. Now, accounts payable. Let's say you get an invoice for $600 worth of supplies from a vendor. You haven't paid it yet. Your entry looks like this. Debit, supplies expense, $600. Credit, accounts payable, $600. This shows you owe money, and you've recorded the cost. When you pay the bill, you update it again. Debit, accounts payable, $600. Credit, cash, $600. That clears the debt and reflects the cash going out. These entries help you track what's owed and what's been paid with clarity and accuracy. Now let's look at the flow, how these transactions move from start to finish. For accounts receivable, step 1, you make a sale on credit, you record revenue and increase accounts receivable. Step 2, later, the customer pays, you increase cash and reduce the receivable. So, the income was recorded earlier when the work was done. The cash comes in after. For accounts payable, step 1, you receive goods or services and get a bill. You record the expense and increase your accounts payable. Step 2, when you pay, cash goes out and the payable is cleared. This timeline matters. It shows that revenue and expenses hit your net income right away, but the cash might move later. That's why tracking receivables and payables is so important. It helps you understand what's really happening with your profits and your bank account. Let's go over some common mistakes to watch out for. First, mixing up receivables and payables. Remember, receivables are what customers owe you. Payables are what you owe to others. Get the direction right. Second, forgetting to update your books when payments are made. If someone pays you or you pay a bill, your accounts need to reflect that. Leaving them open will throw off your reports. Third, recording cash instead of using receivable or payable accounts. If it's on credit, don't skip the middle step. Record it properly so your cash flow picture is accurate. And last, not aging your receivables. You need to know which customers are overdue and for how long. Without that, you might miss unpaid invoices and lose money. These small errors can lead to big problems. Catch them early, and your books will stay clean. Let's see where accounts receivable and payable fit into the full accounting cycle. After you make a sale or purchase, whether it's on credit or not, you record it in the journal. That's the first step. Then, these amounts show up in your trial balance as part of your daily bookkeeping. Before you close the books at the end of the period, you'll review and reconcile both receivables and payables. You make sure everything lines up, who's paid, who hasn't, and what's still owed. On your financial statements, accounts receivable affects the income statement by recording revenue, even if the cash hasn't come in yet. Accounts payable affects expenses, even if you haven't paid the cash yet. And both show up on your balance sheet, receivables as a current asset, payables as a current liability. So they play a big role in your business's financial story, from daily transactions all the way to year-end reporting. Let's do a quick recap. Accounts receivable is the money coming in from customers who owe you. Accounts payable is the money going out to suppliers you owe. They show how your business handles credit, and they're essential for tracking cash flow, staying organized, and getting accurate reports. If this video helped you finally understand how AR and AP work, go ahead and hit like, subscribe for more simple and clear accounting lessons, and drop a comment if you want a full walkthrough on things like aging schedules, bad debts, or credit terms. You're getting closer to mastering the full accounting cycle. Let's keep going.